Hey everybody, Signet here with the Bullish Bears. I wanted to welcome you to video 2 of Spot and Risk Trading Strategy. Now in the previous video we discussed why we use these spot and risk markers, about how price gravitates there and tends to become a support and resistance, how we structure our trades taking entries on spot and getting risk out of the trade on risk, of letting our runners run and moving our stops to make sure we lock in profits and do not take losses from our runners. In the previous video, we were looking at a NASDAQ chart that just had lines drawn on it. In this one, we're actually using the indicator that we're going to be focused on with this strategy. So you can see here the 42 and the 25 are a different line color and line type. And the reason for that is this part of the price structure, and it doesn't matter that we're at 75.42 and 75.25. If we was at 65.25, it would be the same. If we were at 55.25, it would again be the same. The way that price interacts in this particular area makes it unique from the other areas, right? And so in this area, what we do differently is we trade from the 25 to the 42. 33 is the middle between those two, all right? On the bigger picture, and it's something that we really want to look at, and I call it looking at the bigger picture, taking the bigger bite. The NASDAQ does move in these 10 block handles, but what we do always want to remember and focus on is price moves from the roundy, and roundy just means from the whole number. So 7,500 to 7,600, 7,600 to 7,700. Price moves from roundy to 50. All right, so 75.50 is a key level, and the roundies are key levels. Price goes from roundy to 12. All right, if price breaches the 12, means crosses through the 12 from below, we would expect price to seek the 33. From the 33, we would seek the 50. From the 50, we would seek the 62. From the 62, we would seek the 88. And from the 88, we would again seek the roundy. That is taking price from roundy to roundy. All right, that happens quite a bit, especially with the volatility going on in the NASDAQ right now. And in a little bit, I will zoom out and show you kind of some of the price action that we had Friday. So I'll start walking through it here. Actually, at the close of the EU, which is at 10:30, we often see a change in market sentiment within 15 to 20 minutes. Now, sometimes that change in sentiment just takes us from a a downtrending market to a sideways market, or from an uptrending market into a sideways market. Sometimes it takes us out of a sideways market and sends us into an uptrend or a downtrend. Friday, when I was trading the NASDAQ, I was watching for this change in the EU, and I was looking at this price. We had just broke off of the 33 and had come back up into the 66. And remember, we seek the 62 from the 50. All right, so price had moved from the 50 to the 62, and we were getting the retrace, and I put a bid in on the 66. So I had my order waiting to go long off of this price movement, and then I was in the trade. I took risk out here on the 72. I got in at the 66, took risk out at the 72, and then I left my runner on and ended up taking one heck of a ride on Friday. Now, we can't always expect to get that kind of market action out of our runners. That just happened to be a little bit of extra in the trade, so to speak. But it was a nice run, and I had a runner in it for the entire action, and I ended up getting stopped out either on the 66, the 606, or on the 612. But either one of those, it was a nice run that I was in. It's a really great example of how leaving our runners on can really get us day done very early in our trading day. You can see that price went from around 7,500 all the way up to 76.18 and all the way back down into 75s again. So look here, 75.18, 76.18. We made 100, and then we came right back down throughout the day. Right? So this is a really great example of why we trade the NASDAQ with this strategy. We want this volatility. We want to go from spot to spot again and again until we're day done. Right? So this is just a really great example on Friday of the kind of price action that we're looking for. It's why we trade the NASDAQ. So in the last video, I talked about markers and spots being open from above or below, and how this strategy really doesn't offer you direction for your trade. It just offers you structure to identify where to take risk out of the trade and where to take profits. All right. This is a very simple trading strategy. All we're doing is going from spot to spot and taking risk out of the trade following rules. That's it. It's very simple. Price does move differently in this channel. You can see that the 33 provided some really strong resistance here and then offered some really good support. Price went from the 25 to the 42. Price went from the 42 to the 25. All right, so this area is traded differently. You can trade it aggressively. You can put your order in on the 25 and look to take profits on the 33, take risk out, and then let your runner run to the 42. That is an aggressive trade. It's a lot bigger, right? That's 8 points. So it is a bit much. It's a bit more than the regular trading strategies up here where we identify, we risk 4 to make 10. This is a different area. You don't have to put that kind of risk into play. If you got in at the 25, you could look to take profits at the 29. That way, you still get your 4 points in case price turns back. You could see that you would have got paid here if you had done that. You would have gotten risk out of the trade. That would have ended up with a risk out, stop out, but you would have at least gotten paid, right? Whereas with this one, with this candle, you might have gotten filled, maybe. You might not have, right? And then you would have ended up down here. So in this video, I do want to talk about what happens if the trade goes against you, what the rules are about exiting a trade that you got wrong. All right, so what we're going to do is I'll start to zoom in to some price action right here, where we could have taken a trade going long and ended up being absolutely wrong, and what the rule would be to manage the trade. So I think I'm zoomed in pretty good here. So if we were in this trade and price had come up here, say we took a trade from this point, took our risk out here, ended up getting stopped out, saw the price action take another run, right? It tested that spot or that risk again, had come back down, and on the way back down, suppose we put an order in to go long here, right? Persistence beats resistance. So if this had tried again, this could have been a nice breakout to the upside. We don't know, right? So we could have put our order in here at the 66 to go long. And instead of getting risk out of the trade, we started taking heat in the trade, right? It started going against us. At this candle here, it had not yet opened the 62. It came down and touched it. Just barely touched it, but it didn't open it. This one did. This candle gave us a signal to get out of the trade. All right, that's the rule, and we would want to start looking for an exit at this point. Now, since risk often is a place where price bounces, you don't automatically have to flatten and exit your trade right there, right when it crosses and breaks through. You don't just have to hit the button and bail on the trade. You can anticipate a bounce in the next candle. If that next candle does not bring you back up to even, use it to get out of the trade. Don't wait beyond this candle. All right, it's a 2-minute candle. You have 2 minutes to decide if it has got you back up close enough to get out. You don't have to eat this 4 points of loss. You can see that this offered us back out with 1 or 2 points of loss, right? It did offer us an opportunity to get out of this trade without eating all 4 points. But you want to get out at the next candle. That is the rule. Now, if this next candle had broke back above our entry, well, then of course we would just stay in the trade. But it did not. And we could see that you can watch the clock while you're in the trade, right? You can see it's ticking down. If you're in the trade and the candle is not giving you an opportunity to come back above the 66, you need to get out of the trade. That is the rule. Now you can see it closed here. That was the close of the candle. That's 75, 66, 63. That would be where you would exit the trade. You could have got out sooner at a higher part, perhaps in the wick. But the rule says if you got in at the 66, started taking heat, and the candle closes below the risk, the next candle, you get out. You do not argue with this. You do not decide, well, I disagree. I really think price is coming back up. I'm going to give it a few more candles and see what happens. No. Follow the rules. Get out of the trade. And I can't stress this enough. You have to follow the rules of the trade. Now, if you're a trader who's been trading for a long time and you've already got your own system of risk and reward and you want to trade this however you want to trade it, that's your business. Just recognize that if you're not following the rules as they were developed, then you're not trading this strategy. You're not trading spot and risk. You're trading your strategy, okay? And that is whatever it is that you decide it's going to be. I disagree with just automatically bailing out here, but I do it. And I've done it consistently enough now that I've realized the benefits of following the rules. Okay? The NASDAQ is a very volatile product, and it can absolutely rip in a single candle just like this. Okay? You do not know when something like this is going to happen. If we had a trade entered here at the 66 coming in from below, say we wanted to go long, and and we would have broke a rule there to get in. So let me just stop there. We wouldn't have taken this long until we had a candle close above the 66, right? We would have waited for that candle close to go long up here. So I'll just stop that scenario and just, recognize the fact that if we're taking heat and we don't get out of the trade where we're supposed to, that you can get price action like this, that instead of taking 4 points of loss in a trade and exiting the way you're supposed to, you could absolutely end up with a disaster stop at minus 14. Okay? Because if we were in the trade from 66 to go long and you get this kind of candle, you're now sitting down here at 52 with minus 14. All right? So follow the rules of the trade. So I am going to end up trading this live and recording it as a part of this video series. But we're going to walk through a little bit of this right now to kind of demonstrate the way price action would work. So if we had this move here and price was testing the 56, when we had this candle close above 66, that would have given us an opportunity to put our order in here. So we would have offered our order on the 56. We would have got in there and we would have offered one of those at the risk spot. All right, so we would get out with all but one. So if you're trading more than two, you would exit all of your contracts except one here. So we'd offer one, and now we still have one. When we got our risk out, we would have offered our stop loss at the 56. All right. With our stop here, once we took risk out of the trade, if price came back down, it would have stopped us out where we had gotten in, and we would not have lost any of our profits that we had collected up here. Now, when price broke above the 66, we could take our stop and move it up. All right. So when we had the close above 66, we'd now have a stop here. If price had continued above 72 and closed above 72, we could then take our stop and move it up to 66. Right? You kind of see where I'm going with that. We want to keep moving our stop loss up as price continues to move, but we don't want to get so close that we end up choking out our own trade. Right? Now, since we did not get the close above 72, our stop would have been down here. And that's where we would have taken our loss in the trade unless we identified that this was headed down, and we could have just flattened, right? We could use the dome and flatten our trade and get out somewhere in this area, right? That would have been a pretty decent trade there. That would be 8 points, actually 12 points, because this is from 56 to 62. So we would have got 6 points in 2 contracts. That's 12 points. And remember, for every $10 in the NASDAQ, we're looking at $200, right? For every dollar, it's $20, and every $10 is $200. Now, I did end up putting a little cheat sheet together. Now, I'm going to stop here and talk for a few minutes. So this will absolutely give you time to take a screenshot and to have this something that you can look at later on, maybe print it off and keep it next to your computer. Because we have the roundies on here where I was talking earlier. From the roundy, we seek the 12. From 12, we seek the 33, 33 to 50, 50 to 62, 62 to 88, and 88 back to the roundy. And that works in reverse as well. So even though we are moving 10 handles at a time, we can look at the bigger picture. If price came from the 88 and it's headed down, the bigger picture, we would be looking at price going to the 62. All right. We also recognize that 50 and roundies provide very strong support and resistance. So if we came from the 50, we absolutely would be seeking the roundy, but we would also recognize that the 62 is going to be an area of resistance between the 50 and the roundy, right? So print these out, keep track of them. Also, remember spots are only opened from a spot, not from risk. Keep your perspective on the entire chart throughout the day. Where is the daily pivot? Where is the weekly pivot? Where is VWAP? Where is the roundy? And where is the 50? Those key areas are going to be places where price can absolutely rebound, bounce, stall, get hung up. They are very strong support and resistance areas. It is sometimes difficult for new traders to keep track of that bigger picture, right? And get so focused on the small price movements going from spot to risk, from spot to risk, you fail to look at the bigger picture of where did price come from? Where is price going? Remember, the NASDAQ tick equals 25 cents. The tick value is $5. And what that means is for every 25 cents that the NASDAQ moves, you can make or lose $5. For every $1 the NASDAQ makes, you can lose or make $20. This strategy uses a risk 4 to make 10 risk reward ratio. From risk to risk, we have $10, which is a $200 profit and loss. From spot to risk, we have $4. That's an $80 profit and loss. So what we're looking at is from risk to risk, our profit is $200 before commissions. From spot to risk, our profit is $80 before commissions. All right? And remember, when we're getting into these trades, we're trying to get risk out at the risk line. So if we enter at spot and we take half of our trade off at risk, we've taken $80 of profit off the table. If price reverses and we get stopped out, we call that risk out, stop out. Then we had opened and closed 2 contracts and we made $80 before commissions. Now I went ahead and added typical commissions and fees here. I don't know what your commissions are. I don't know which broker you're using. But let's suppose that a round trip per contract is $4.50. We're trading at least 2 at a time. So you're looking at $9 round trip per trade. If we're getting risk out of the trade, and that's $80, we can just ballpark this and say for every $80 we make, we're giving 10 away in commissions. For a risk out, stop out, we're making 70 after we pay the bills. All right. That really needs to be recognized. That whole this whole trade strategy is designed to do nothing more than to provide very strict rules and a very structured trade. This does not offer you direction. I gotta keep saying that because I heard quite a bit when I was trading this on Friday from people in the room who did not understand why I was placing trades. I would offer contracts to go in one direction or another based on price action, and they were confused and asking how this indicator was telling me direction. It's not. There's no direction in this indicator. The only thing that this indicator is providing is an opportunity to recognize where price will run into support and resistance, and then trading it from spot to risk, from spot to risk, from spot to risk. That's it. Since we were already talking about commissions, I also want to bring that up and get you to realize that you do not want to just trade this all day long. You want to have a target profit for the day, and when you hit that, we call it day done, you're done. You do not continue to trade. If you want to keep practicing, if you want to experiment, go to paper. Get it out of your system. Go throw down on paper trades and just, rock the ballpark. But with your real account, do not continue to trade past day done. All right? This is not some kind of casino. This is not an endless lottery system. Do not take the risk. Set your daily goal, trade your goal, and stop trading. That you have to realize that this marketplace, it can happen in a heartbeat. You'll start taking loss, and then you'll just keep eating loss. It'll get into your head. You'll try to revenge trade. You'll fight to get it back, and all the time you're just paying and paying and paying those commissions. All right? I cannot tell you what your day done is. I've been trading this, looking for day done of $1,000 with 3 contracts. Now, if I wanted to do that on Thinkorswim, I would need an account bigger than $30,000 to trade 3 contracts. All right, it's just the margin requirements. That's just the way that it is. All right, you can see the NQ right here, the NASDAQ futures. You got to have $8,300 of margin to trade 1 contract. We just round that up to 9,000 so that we have some room for price movement. 9 times 3 is 27. All right, so I'm going to need $27,000 to trade this thing on the Thinkorswim. Well, that doesn't work for me, right? I'll trade it on NinjaTrader, and that's just the way it's going to be. But the commissions are still going to eat you up. Leaving aside the fact of how much money you're going to need per contract to trade, you also don't want to put that much money at risk, right? And for every contract, you're increasing your risk. So on Monday, I'm changing my day done from $1,000 to $500. And I'm going to stop using 3 contracts and start using 2 contracts. Now, at some point, we're going to introduce into the community the idea of trading this with the micros, and we would want to use a different day done for those as well, because we don't want to overtrade. It doesn't mean that you can't, trade options for the rest of the day or, get in some swing trades. Just don't sit there all day trying to hammer money out of the market. Okay, get your day done, shut it down, and either go practice on your sim, paper trade, or trade something else. Right? Go spend time with the family. Go do something else. Don't continue to put your account at risk. All right. So while we're sitting here at the 42, I wanted to go through this channel area again. From the 42, we seek the 25. Right? From the 25, we seek the 42. And you can see that price, when it got there, it stalled. I mean, that's where it came from. That's where it was going. Right? We want to look at this on the bigger picture. It was a heck of a day Friday. So I'll just highlight here Friday. You can see that from market open at 9:30, we had a nice run throughout the day. We made, 100 block and back down again. I did trade quite a bit of this on Friday, but I was live streaming in the room wanting to demonstrate how this is put into play, right? So remember, look at price from the bigger picture. Right here was the weekly pivot, right? You would want to take that first test of the weekly pivot short. Just right off the bat, prices running up into this area, you would want to have an order waiting and ready to short that first test of the weekly pivot. Right? I would do that 99 out of 100 times. Even in a strong rip to the upside like this, I would do that 99 out of 100 times. The only reason I did not have a short order up there waiting is because I was already in this trade with a runner and I got stopped out either here or here, and I don't remember which. I would bet here because that's the trade rules that I follow. So that's why I didn't have an order waiting up here, right? From above, once you get spot open from spot to spot, right? The 06 was open to go short. When price crossed through here and you got risk out, you're also going from a roundy, 76 flat. From the roundy, we seek the 88. We got that, right? From the 88, we seek the 66. So we got that too, right? And that's actually where it bounced and stalled out. Recognize the bigger picture to help you understand where you want to take the trade. Because this quote indicator, which it's not really an indicator, all it is the same prices. Look here at the bubbles on the side. It's just drawing lines for you so you don't have to sit there and draw them yourself. All right? These numbers never change. They'll stay no matter what block we're in. If we're in the 65.55 or 75, it doesn't matter. These numbers never change. They're always in the same spot. All right? All we're doing is going from one block to the next, but this indicator isn't giving you direction. It's not telling you or offering an opportunity or an indication to go high or low. There's no signal here to take it short or to go long. This indicator does not provide any of that. Price action tells you that. When you combine your analysis of price action with the risk and reward ratios developed in this strategy, you've got it all figured out. That's it. That's the whole name of the game right there. All right. So from below, when we get a break above the spot and a close above the spot, we can look to go long. If we're expecting a bounce or a rejection, we can have our order waiting so that when price comes up, it can get us in the trade to go short. If we're expecting a bounce from above, we can have our order waiting so that when price comes down, it lets us in the order to go long. All of those are our ways of anticipating price action and having our trade ready to go. We don't want to chase, all right? We don't want to chase. So we want our orders ready to go. Now, one thing that you can do when dealing with the risk reward on the risk out stop out, all right? Risk out stop out is a situation like this. Say I had an order in at the 66 to go long from the bounce, right? And I get filled and price comes up and I get out, right? And I've got my runner. Instead of offering my stop loss right at the 7566, I could offer it at 7566 and a quarter. All right, I hope you understand why you might want to do that. We don't want to choke out our runner, right? Once we've taken risk out of the trade and we have one runner running, we want to put in our stop, but we don't want to put our stop so close that we choke it out, right? But if we always set our stop loss flat, then we'll always end up on a risk out stop out eating both those contracts with only this $4 profit, right? And a way to avoid that is just give yourself a quarter down here. Instead of offering it flat at 7566, offer it at 7566 and a quarter, right? And that way, when you get stopped out, you made that 25 cents. Remember, 25 cents is $5. That would pay for that other contract, for the contract that you got stopped out on. Remember, a round trip per contract, we're calling that $5, right? $4.50, $5 for a round trip with fees, right? So just by offering that 25 cents, your stop out doesn't even cost you that contract, right? Then you're only, out of the $80 of profit, you're only paying for that one contract, the one that got you there, right? So I am going to end up trading this live and making it a part of the video series. We'll have to wait for Monday for that, and I'm really wanting this loaded onto the Bullish Bears website, and I know that during the weekend is my greatest opportunity to get work done. So I might end up trading this on demand just so that you can see it in action. I didn't really want to do that. I do want to show people live, like I do in the swing trade room, how this is done. I don't want people to think that this is fake or that, I got it all figured out in advance and that we don't follow the rules. That's absolutely not true. Trade it exactly how I described it today. And I want to demonstrate that live as I do every day in the chat room. But knowing it's the weekend and I need to get these videos done, I'm going to go ahead and swap over to the on-demand and demonstrate how to trade this in, quote, live market action. So I want to thank you for watching this video, and I will talk to you in the live action video that follows this one.